I'm Khalila Reynolds and welcome to Taking Stock. We're bringing you all the latest business news and telling you how it will affect you and your money. But before we get started, head over to my website, KhalilaReynolds.com, to subscribe to our newsletter. You can click the link up here or in the description box below. Now come on, let's get this money.
First up, Pulse Investments was the top performing stock of 2020, gaining a whopping 222% in the middle of a pandemic and ending the year at $4.83. We'll speak with Chairman for Pulse Investments, Kingsley Cooper, on the remarkable performance and plans for 2021 and beyond. And later, the analysts weigh in on the latest market developments. They'll tell us their 2020 standouts and outlook for the year ahead. Plus, an assessment of Wigton Windfarm results and an upcoming stock split for Salada.
But first, here's What's Hot, brought to you by Jamaica Money Market Brokers, your best interest at heart.
Is Mayberry Jamaican Equities MJE dumping its holdings in DERRIMON Trading Company? Well, recent events had been suggesting some corporate shifting was taking place in the financial market against the backdrop of DERRIMON's additional public offer APO. As of September, MJE was the second largest shareholder in DERRIMON. They were also the lead broker for DERRIMON's IPO in 2013, but are not handling the company's APO, nor are they a selling agent. But in December, Mayberry advertised that it was selling DERRIMON's shares at $2.38, commission-free, each for anyone wanting to get in. That's 2 cents below the APO price for the public. They said they could guarantee fills up to 439 million shares, which is exactly the amount of shares it owns. The advertisement left many to speculate about Mayberry's intentions and whether they were violating JSE rules by underselling the APO. Taking Stock understands that the Financial Services Commission (FSC) asked Mayberry to issue a clarification. The company has since issued a public advisory clarifying that its offer is not part of the DERRIMON APO. WhatsApp has delayed the rollout of its updated privacy policy after an outcry over the changes sent users flocking to smaller rival messaging services like Signal and Telegram. The cutoff date for its 2 billion users to accept the updated terms and conditions has been moved to May 15 instead of February 8. Parent company Facebook said it decided to delay the update to address the confusion and misinformation about the planned policy change. Critics said the new policy would have forced users to share personal data with Facebook. However, Facebook said the privacy change only relates to how users can message a business on WhatsApp, and the policy changes are merely intended to improve transparency and how they collect and use data. Digicel Jamaica has named Jabor Kayumov as its new Chief Executive Officer CEO. Kayumov replaces Alison Philibert, who resigned at the end of 2020 after leading a transition at the company. In a statement, Digicel said that Kayumov comes to the post with much experience, having previously headed the company's Trinidad operations within the last 2 years. Most recently, he spearheaded the relaunch of Digicel as a digital operator in the Twin Island Republic. Kayumov said he's excited and honored to be given the opportunity to lead operations in Jamaica, Digicel's flagship country. Proven Investments is reporting a 75% take-up of its additional public offer in the first 3 days since the invitation opened. The offer opened on January 8 and is scheduled to close on January 29. Proven is offering just over 134 million ordinary shares and hopes to raise up to $4.3 billion or 30 million US. Co-founder and CEO of Proven Management, Christopher Williams, said he's satisfied with the response to the APO, especially during this period of uncertainty and shifts caused by the pandemic. Proven plans to use the proceeds of the offer to build its capital base and pursue expansion and acquisition opportunities. The Wisynco Group is thinking of buying back some of its shares from the market to get the stock price trending up again. Wisynco Group Chairman William Mafood made the disclosure to shareholders during the company's virtual annual general meeting last week. The stock is currently trading within the $16 band, but has closed as high as $24 in the past year. Its decline coincided with the overall drop in the market following the COVID-19 outbreak starting in March 2020. Some 3.75 billion Wisynco shares trade on the Jamaica Stock Exchange. First Rock Capital Holdings has acquired 5 luxury residential units on the 7 Mile Beach in Grand Cayman at a cost of over $3 million US. According to First Rock Group co-founder and CEO Ryan Reed, the company secured financing of about $1.6 million US towards the acquisition. This represents the company's second major investment in the country, having deployed some $3 million in a luxury development in the West Bay area of Cayman in 2019. RF Holdings has partnered with financial technology company BIT to build a platform to allow for digital currencies across the region to be accepted and accessed by a wider network of Caribbean clients. RF Holdings is the parent company of a group of investment banks in the Bahamas, Barbados, and the Cayman Islands. The platform will be based on BIT's digital currency infrastructure. The immediate goal is to facilitate transactions based on available digital currencies in the Bahamas and Barbados. The services will eventually be offered to the rest of the Caribbean.
What's Hot was brought to you by Jamaica Money Market Brokers, your best interest at heart. And when we come back, 2020 was a standout year for Pulse Investments, which is no longer just a modeling company. They've diversified into media and real estate. We'll hear more about their plans. This segment of Taking Stock is brought to you by Bulwark Insurance Agent. Insurance made easy. Welcome back to Taking Stock. Pulse Investments skyrocketed as the #1 stock of 2020. How did they perform so well during a pandemic? Joining us now to discuss is Chairman of Pulse Investments, Kingsley Cooper. Hi, Kingsley. Welcome to Taking Stock, your first time on the program, and Happy New Year.
Happy New Year to you, and great to be with you, Kalila.
And what a good time to have you on. #1 on the Jamaica Stock Exchange last year. Your stock price up 222%. You've had a great year.
We can't complain. And, it's particularly satisfying in a year that has been as challenging as 2020 was. So, it's good to know that we are largely COVID resilient, and that our shareholders have taken note. And so it's really quite satisfying.
Yeah, so you also had a stock split earlier in the year. You had announced plans for an APO that had to be put on hold due to the circumstances, which are understandable. We're going to get into all of that. But to what do you attribute Pulse's stellar performance in 2020 in the middle of a pandemic?
Well, over the years, we have diversified. Although some of our income streams were challenged, others were not. For example, our rentals business surprisingly held up very well because we have a number of spaces we rent here at Trafalgar as well as at Villa and I. You must have been up to Majestic, the restaurant there. And this is a time now we're pushing for additional tenancies. But that has been one of the strong performers. Television has been a very strong performer in the COVID period because, of course, more people have been staying home and watching TV. So programming, we have found broadcasters in different markets, new markets, and even markets that we've been in for some time, asking for additional programming and so on.
Content has been, I know there's been a demand for content in COVID. I mean, my business has certainly benefited from that.
Absolutely.
But I've heard media entities complain that there's been a fall off in advertising. Is that one of your revenue streams too?
Not significant. I mean, yes, but that's not the main part of it. We get paid for programming. So that is a key for us. So, those are areas that have done very well. And of course, there are other things like, as we continue to expand our real estate portfolio, the whole business of investment property gains and so on. So, there are a number of things that we have done. The modeling industry had a sharp decline at COVID time, but after a while, it sort of found its legs again. Certainly New York, where most of our top people are. So that has not been so bad. I mean, we did have a decline, but we saw a pretty strong resurgence. And Alicia Burke, for example, who's our top model, is doing really, really well. So, it's a lot of things have happened that have been gratifying. And overall, that has helped us to maintain the level of profitability that we would like.
Right. And as you mentioned, the modeling industry, that is something that I think most people still recognize the Pulse brand as. And I'm sure there are many people who don't even know that you're as diversified as you are into real estate, into media, into all these different things that you do. How much is the modeling part weighted in your portfolio now since you've diversified so much?
Wow, it's less than 10%.
What's the bulk of your portfolio now?
The bulk of it is real estate and television. So real estate is probably about almost 50% or around 50%. TV about 30%, and everything else another 10%, and modeling just under 10%. So it's a pretty diverse. And there are other areas too that I have not mentioned because the numbers are not that significant yet. But there are a lot of things we have put on hold, things like Pulse Global or expansion of even the opening of the suites at Villa Renai and so on. We were put on hold because of the pandemic. So once these actually get off the ground, because our performance over the last couple of years has been without the benefit of Pulse Global, without the benefit of Pulse Suites, and even Pulse Rooms at Trafalgar, it's a relatively small part of our business. So, once those come on stream post-pandemic, we're very optimistic that things are going to go, through the roof. And then, of course, we have Pulse Homes coming on stream in the Valley in 2022. So that's something else to look forward to. We're going to do 30 3-bedroom homes, eco-friendly homes in that lush, tranquil space at Villa Renai. So a lot to look forward to.
You acquired a part ownership in a New York radio station last year too, right?
We haven't. We intended to, and we still might, but because of some of the changes we had to make, it hasn't happened yet. But we have a strong association and partnership with IRIJAM, and we hope that in time we will get that done.
But it sounds like you have a lot of plans in the works, and you are positioning yourself for growth. Tell me some more about Pulse Homes, this project that you have upcoming. You said Villa Renai, and that's a property owned by you personally.
Right, but Pulse is acquiring that property, in the process now of acquiring it. And it's really exciting because if you know Villa Renai, it's such a lush and beautiful place.
Yes.
And of course, most people just know when you get into Villa Renai, the front of Villa Renai, but it goes down the valley, across the valley, going towards Kingston. It's all of 9 acres. So the homes will be in that area, the valley and the hill surrounding the valley, so that each home will have its own discrete space, and eco-friendly, and it's going to maintain that lush environment with all the plant life and everything else, and so on, and a little bit of Mrs. Renai's artifacts and so on will be reflected in the space. So it's something that's pretty exciting. And if you've seen the drawings, you'll understand that the architects have done an amazing job.
What type of price point are you looking at for these homes?
It's luxury-ish, somewhere around there. You're looking at maybe about 70 million for 3-bedroom homes. They're not townhouses, they're actual homes with their own land space around them and everything, although it's a gated community. But of course, at this stage, we're still waiting on the final building approvals and so on to actually sell.
What
so
timelines?
We hope to start building in April, May, and to complete at the end of 2022.
Okay. Well, you mentioned that your real estate portfolio, you said surprisingly, hadn't been very hard hit. And I noted the word of the choice of that word, surprisingly, because it had surprised me as well, not just your real estate portfolio, but the performance of real estate in general during this pandemic. A lot of people had expected prices to fall quite significantly, as they tend to do during a recession, but real estate has held firm.
And in many cases, prices have risen.
Yes. Why is that? Why has real estate been unaffected by the pandemic?
It proves that people, real estate is very resilient. People will always want a great space in which to live. They see real estate still as one of the best investments you can make, if not the best investment, certainly for the average, the average person. And so, real estate continues to be in demand, and somehow it's, demand is outstripping supply. Because we thought with all of those high rises going up and everything else happening, people struggling to qualify for mortgages and so on. But then there are also a lot of cash buyers.
And you're seeking to take advantage of that.
Well, you have to take advantage of all the opportunities, as you know, especially when there are areas that in which that you have to just sort of put on hold.
Yes, but you've chosen to go into the luxury home development as opposed to all the high-rise luxury apartments that have been on the market. And that's a strategic move too. So why did you choose this segment of the market?
Easy choice, because we're talking about Villa Renai. So obviously you're not going to put a high-rise in Villa Renai. You're going to put something in there that's eco-friendly, that reflects the essence of what Villa Renai is about, that whole tranquility and that natural beauty and the whole timelessness of that space. The Renai family developed Villa Renai almost 100 years ago, 80 odd years ago. And I started the reconstruction back in the 90s. We have always thought it important to maintain the essence of Villa Renai, the natural beauty, the tranquility, the timelessness. And I might have mentioned that Mrs. Renai and her family developed the property 80 odd years ago. So we have tried to ensure that, the key artifacts and the sculptures in the gardens and so on have all remained intact. And, we have adopted a new mantra for Pulse, which is leisure, lifestyle, living. The whole idea of combining the creative elements of Pulse, the beauty, whether it's models or any of our fashion, with media, with hospitality, with the Villa Renai features, and now with the homes. And so the whole idea is living, and all of those elements in a unique blend that now represents the new Pulse.
What led you to make that transition, and how long has it been since you've been putting more emphasis on the real estate portfolio?
It's been a while, because we acquired Trafalgar Road. Well, I acquired Trafalgar Road in 89 and Villa Renai in 94. But it was always meant to be a facility for Pulse. And so we've been slowly developing over the years and expanding and bringing everything to bear. So even as persons might have thought that we were not as keen on modeling or we're not as keen on fashion and everything else, we used to do concerts, as you know, and the clubs and all of that. It wasn't that we weren't so keen, but it was that we're developing other areas of our business to create something that was more diverse, but at the same time had synergies that made them all work together. And then to come in the end to create one product that pulls all of these elements together and create something that is beautiful and unique and special in the market.
And even though I'm talking to you now as chairman, Kingsley, your daughter has actually taken over as CEO in the day-to-day operations. You must be pretty proud of her.
I am, and actually she is one of two CEOs. Safia is doing an amazing job, and so is Romeo Gordon, who is managing director, but her portfolio is fashion, television, the modeling agency, more of the creative side. Mm-hmm. And Safia is the real estate, the nuts and bolts, the properties, hospitality, those areas. So, they're both playing critical roles in the business, and I'm in transition mode. So, although I'll be there to help and guide and support.
You want to just live your life now, right?
Years. I'm sorry?
You want to live your life now?
Well,
I'm sure you have lived.
I'd want to say yes, but the truth of the matter is that the best life I've lived has been my life at Pulse.
Yes.
And doing the things that we do. And that is one of the reasons why we chose this life, or I chose this business, I chose this life, because it allowed me to do business, build something that had never been done before.
Yes.
But at the same time, to enjoy my life. And if you think about all the things that Pulse does, from the parties to the events to the model industry to everything else, real estate and places like Villa Renai, you understand that I really do enjoy this life to the max.
Yes, I'm very sure of that. You've had to travel all over the world, amongst the company of the most beautiful women. I mean, who wouldn't want Kingsley Cooper's life, right?
Unfortunately, it's not as wonderful as it seems. There's so much hard work and so much challenge, because trying to make business out of something that everybody sees as fun is not always the easiest thing. First of all, a lot of people don't take it seriously. And then secondly, even the people who take it seriously, would say, it's just too much, So it's a challenge for a lot of people in different ways.
Yes, yes. Last year we heard talk of an APO for Pulse, and that seems to be the trend. A lot of companies coming to market to raise additional capital. And based on the things that you've outlined so far, it sounds like you have a lot of plans, and you're going to
you need a lot of money, right?
Yeah, want some money to fund all of these plans. Yes, so tell me where you are with the APO now.
We haven't forgotten the APO plan, but even some of the big financial companies pull back in COVID, as you would have seen. I see them now coming back to the market. And obviously there's a sense that there is a greater ability to raise funds now in the capital market. So it's something we certainly are going to look at again, maybe if not in 21, certainly in 22. But we are also looking at other forms of funding, because as you rightly say, these plans are going to take quite a bit of cash. And, moving from the millions to the billions, it's that kind of demand or requirement in terms of what you're going to need to accomplish all these objectives.
Right, because there's also a lot of competition for funds on the market now, since everything that was on hold in 2020 is now coming in 2021. So you're looking at alternative forms of funding. Can you say what types you're looking at?
Probably bond funding. We already have secured some funding, but we will announce soon once we're in a position to, because we have to tell the stock exchange first what we're doing.
You're going to be using the JSE's new private market?
Probably, but I can't say too much.
Right.
I don't want to get a note on Monday morning from anybody.
I know how that is. They're very
Harbour Street. So.
Yes, they're very strict.
But there are plans in the works, and we're pretty advanced with a lot of it.
Okay, so you're not relying on this APO to go ahead with, for example, Villa Ranai homes.
No, we're moving forward. We're moving forward regardless, and the APO will come. And if there's money we have to retire from APO proceeds, or further expansion from APO proceeds, whatever we have to do, we'll do it then. But there's no reason not to go forward, and there is enough income to be generated in terms of our operations, as well as the new activities in terms of selling the homes, because we'll maybe sell half of them, keep half of them, something like that. So there's no reason not to go forward.
Where do you see Pulse Investments in the next 5 years?
Whoa, that might be a better question for Safia and Romeo, but the truth of the matter is that I think that we'll be looking at a much larger entity, possibly even more diverse, possibly even more international, given the fact that by then we hope COVID will have receded totally, certainly in 5 years. So I just think it's going to be so much more in every respect.
Well, I look forward to witnessing this ride in 2021 and beyond. Kingsley, all the best to you and Pulse.
Thank you so much. Great talking to you. And it's my first time. Hopefully it won't be my last.
I'm sure it won't.
All right. Thank you.
Especially if you keep performing the way you have.
Thank you.
All right.
Thank you.
Up next, we've got your market recap, and the analysts are standing by. This segment of Taking Stock was brought to you by Bulwark Insurance Agent. Insurance made easy.
Time now for your market recap, brought to you by Sagicor Investments. Think wealth, think Sagicor Investments. The Jamaica Stock Exchange declined last week, with the combined index losing almost 1%. 102 stocks traded across both the main and the junior markets of the JSE for the week ending Friday, January 15, 2021. 36 advanced, 51 declined, and 15 stayed the same. 124 million shares changed hands on the Jamaican dollar market, totaling nearly $414 million. DERRIMON Trading Company, which currently has an additional public offer on the market, traded the most. It took up 25% of market volume. The stock gained 3 cents to open the week at $2.38, 2 cents below APO price, and notably the same price being sold by Mayberry. Wigton Windfarm ordinary shares traded the second most, with people buying and selling 13 million shares in the company. The stock lost 1 cent to close last week at 74 cents. And the Trans-Jamaican Highway was also among the most traded, taking up 10% of market volume. The stock lost 5 cents to open the week at $1.30. Now let's see who else had the biggest gains. JMMB Group 7.25% VRJMD CR preference shares rose nearly 36% last week. The stock starts this week at $1.63. Mailpack Group gained nearly 30% to close last week at $3.74. And the Salada Foods Jamaica shares gained nearly 21%, its stock ending the week at $34.67. On the losing side now, Epley fell 26% to close last week at $20.61. Sterling Investments USD fell nearly 16% to end last week at 2 cents a share US. And rounding off our major decliners, KLE Group declined 15%, down to $1.16. Market Recap was brought to you by Sagicor Investments. Think wealth, think Sagicor Investments.
This segment of Taking Stock, The Analysts, is brought to you by Jamaica Money Market Brokers and Proven Wealth. Welcome back to Taking Stock. I've got a team of analysts to examine the week in business. I'm joined by equity trader at JMMB, Clive Charlton, investment analyst at Proven Wealth, Julian Morrison, and business writer at The Observer, David Rose. Happy New Year, guys. Our first time seeing each other since the year started. Hope it's a good year. I hope it's off to a good start for all of you.
New Year, Kalila.
Yeah.
After a great start.
So we want to first look back at 2020 and look ahead as well at 2021. I see, David, you had an article in The Observer with your top picks for 2021. So what stood out for you in 2020 and what are you looking at for the new year?
Well, we saw a great opportunity during the COVID crash, because there were two events in the year that I would have called major turning points, which have been, as I would say, a time to take profit and then re-enter later. So when TransJam prospectus dropped, I reduced my position in that timeline to reduce the selling pressure that would have come on several stocks as persons rushed to invest in TransJam. And then the second event was COVID. So those two preceding events around February, March really end up pulling the market down, but in that same sense, brings the opportunity for buying. So you even saw great stocks like, the Sagicor Jamaica went as low as $34, JMB at 28, NTB at 130. You had so many steals during the last year, whereas you say side companies and even companies that rallied later on in the year. So also at Wood Pulse, which was the best performer for 2020, 122%, went as high as 65% at that point in the year. And that was, preceded by the company's decent run up in the final quarter of 2019. And then stocks which end up further driving the price. Although the company didn't execute on their APU as planned, the overall stock split and in the further optimism and Pulse results, which was driven heavily by re-evaluation gains, end up pushing the stock very high. So in adjusted split terms, Pulse started the year at around 90 cents and ended around probably $4.90. That's a pretty good execution or return for your money. $1.50 to $4.90. So you can see the kind of returns you have received holding Pulse before the split and after the split. Then you had Siboney leading the next high performer at 100%, but that was within the last quarter in terms of, relative speculation because Siboney isn't still a company that's operating anymore. It's still listed because the principals of FinSAC want to sell somebody else to the reverse takeover, but no one has taken up the offers yet. So that bonds in Siboney 100%, to since 22 cents, it seems like something, but as I said, it was just really speculation in that sense. Then you had other guys like Epley, Key Insurance, Mailpack, Margaret Turks JMD. Margaret Turks is an outlier, but there's certain companies that retracted but regained their strength later in the year as the market started to recover and in some sense or semblance. With respect to 2021, there are going to still be some struggling in terms of the index recovering because about 50% of the index or more or about that range is tied towards NCB, FG, Surgical Group Jamaica, and Scotia Group. So, and by to this enter $100 million club. So those stocks are really, if they don't really move within the year, as we saw like in 2019, the market itself would still be growing at a slower rate compared to prior times.
Okay, so that's David's year in review. Julian, what was the highlight of 2020 for you and what are you looking forward to in 2021?
Well, the highlight was definitely Barrita's capital raise. That was also another turning point on a positive note. What it did was change the paradigm in terms of capital raising because clearly the economic fallout combined with the pullback in the index would have shifted investor expectations. But seeing a company raise that amount of capital on the same market shows some kind of proof that businesses can still take advantage of the capital market in a successful and meaningful way. As we have seen, that capital has been put to work already in the DERRIMON deal. So apart from that, there are some other companies that really did well in terms of their earnings. SEPROD did really well last year. There are a few others. I expect strong performance from Fontana even, because these businesses have been able to really focus on their business model and take advantage of the situation at hand. So for example, in the case of SEPROD, clearly they sell consumer staples. So these goods will do well in economic conditions that are adverse because people still have to consume basic food items, regardless of what's going on in the economy. In the case of Fontana, they have a very strong niche. They have very good strategic locations. There are still dividends to be had, pun intended, from their new location, fairly new location, Waterloo location. Their parking lot is always full and their clientele has a certain level of income. So because of their niche and the fact that they have a novel shopping experience, they have a very strong competitive advantage relative to the context of Jamaica. And I still think they have further to go, especially if they intend to expand in new stores. So the highlight was the fact that, yes, so the highlight is the fact that there are companies that were still able to, one, raise capital and two, outperform in terms of profitability.
Right,
so,
more than weather the storm.
Yeah, definitely. So I'm looking forward to it. NCB did well, I think, regarding the circumstances. Their investment in Guardian has proven to be an excellent move. And that's what they call, strategic business planning, because we can see where the Guardian insurance investment really supported them on a segment basis. When you look at the segment performance, it's really the insurance that carried them through in terms of a comparison across segments. So we expect more deals to be had in the future, both from NCB and other companies. They announced Stratos, so that should also reap rewards for the company and for shareholders alike. So let's see, I'm bullish, and I think this year should be even more exciting. We should see more capital raises. The fact that we had less capital.
Last year was exciting in a different way.
Definitely.
I don't even know if exciting would be the word I would use to describe last year. So recovery should begin this year. Clive, what are your thoughts on, what's your assessment of 2020? Anything stood out for you in the year? What were your highlights? And 2021, look ahead.
2020 was really unusual. I think, as I say, it's 100 years since this pandemic. We've had a few outbreaks in previous years, but this one is global. I think our economy has been coming through a recovery process, over the last several years. Began probably about 6-7 years ago. And then, bam, this tourism was doing well, micro, and there's a major shift and focus on micro and MSMEs. And then this pandemic happened, and it really threw a lot of businesses, especially small businesses, out. So the big highlighted, the highlighted, what I've seen, the big highlights from in 2020 is, of course, the pandemic and its effect on the marketplace. But again, behind every dark cloud is a silver lining. So when prices decline, especially for issues related not directly to the businesses, but exogenous reasons, then there's a new opportunity. The financial companies would have had a liquidity issue, So the government, through persuasion with the authorities, BOJ, and I thought it was a very sensible and timely move, curtail the payment of dividend. Of course, it impacted largely significant shareholders, companies that owned 1% and less, many companies, financial companies directly, and financial holding companies, paid out perhaps to the persons who held less than 1% of shareholding. So that to me was significant. But there are quite a number of highlights, positive highlights. 2020, I think, began with a lot of companies having some strategic move to grow their business lines. And then many of them had to postpone it. But quite a few things happened because we have seen, for example, a few takeovers, mergers and acquisitions. We have seen a few consolidations. We talk about the dividend policy, which means that companies retain the capital and therefore can drive business. And I think a very interesting thing to me highlighted is that Barita tested the market, was the first to test the market, the capital market.
Yes,
and
another choice of Barita. Yes, that definitely was a turning point because now we've seen this flood of IPOs, APOs coming out after the Barita success. And they did it in a huge way. So Clive, what are your picks for 2021?
Well, here's what I can say. I think the financial sector will make a turnaround, largely because of how their financial statements are positioned versus the real sector. Financial companies, whereas a real sector has factories, has inventory, has all these hard, physical, tangible assets that did not decline as much on the balance sheet. So the value of the company remains relatively stable during the COVID period. Financial companies were different. They have larger financial assets. These are tradable and fairly very liquid. So these had a precipitous hit during the COVID period and prices fell. So their balance sheet was impacted heavily. And that is why BOJ kind of came in and said, we will help you, the government, the authorities, but help yourself also in terms of how much cash you release through dividend payment. And people and shareholders understood that,
Any specific ones in the financial sector that you're bullish on?
Okay, well, I'm certainly bullish on a company that is very late. The P&L is still struggling, I believe, but it's in recovery phase. I think Scotia Group. The balance sheet is wonderful. I think it's one of the best balance sheets pre-COVID in the financial sector industry. I'm also bullish. We don't speak much on our own company. We don't recommend at all our own company. But the acquisition of Sagicor Group is a big plus in 2019, and the benefits flowed right over into 2020. That even though we had an impact, COVID impacted us, we were able to stave off some of that impact. But the company began to recover quickly in the latter part of the year. Yes, I'm looking at DERRIMON, which is still in the capital raising phase, but they were able, what interests me most about them is that even though revenue is relatively flat, gross revenue, we were doing our investigations long before, and we realized that they were focusing heavily, they were data driven. You see, and they were focusing strictly on the numbers in terms of their acquisition, their placement of business, and how they run the business lines. And it worked out. If you look at their 9 months results, now with this API, they're going to pay down on debt. How much are the whole? I don't know, but they could save upward of nearly 200 million on their costs in their P&L. That would boost earnings per share. Of course, the balance sheet is going to be well improved. You see, they're going to make some acquisitions in the high heavily, what you call it, ethnic markets in the United States. And those companies have done some research on them, have been doing quite well. So we expect that to come on. So I think that is a company that we should also look into.
So let's get David's 2021 picks, because David, you gave us your year in review, but I still want to hear, what are you bullish on for 2021?
So you kind of saw some of my picks in the Observer.
Yes.
Yeah, and that way. So for one, First Rock for sure, because for one, companies doing relatively well, has been paying out dividends stable, and on top of that, made a acquisition, should be making some significant headway in some of the real estate projects, and they're purchasing in Guyana, which was a great outlier, if you want to call it that, across the 2020 segment, geographical space we were. So, and remember, they came at book value at IPO, trading still below book value, or quote unquote IPO price. So there's a great upside potential right there in that sense of, once they're able to execute acquisitions or actually accrue certain things onto the income statement, it's going to be a different story. Then you have the big player, Mailpack. So some people, Mailpack actually run up this week, like from like $2.88 to like $3.60 to Thursday. So with Mailpack, what we saw with those price mark lines were just ridiculous. And then the third quarter, which was September 2020, showed us and demonstrated that Mailpack literally has a far way to go before we can really start to appreciate the value that they present. So what we saw for price mark was that more persons were using price marks through Mailpack to order their goods. More persons were ordering goods to Jamaica, tablets, office furniture, different items needed to, make your home life relatively more stable and, make this adjustment easier. So you're still going to be seeing that kind of level of imports going into 2021. And Mailpack is a courier that has, said that they're going to expand within the Caribbean, not necessarily just acquire companies in Jamaica, because as people need to remember, it's a low barrier entry field, and it's a zero-sum game to keep acquiring competitors without actually having a strategic mindset of how you're going to grow the business. So when they actually start going into the Caribbean this year, your potential acquisitions, it's going to be pretty interesting, because technically that generates upwards of $100 million every quarter, and it pays us mainly in dividends. And they can now just take some of that cash and just put into acquisitions, or just use that kind of cash flow generation to leverage debt. So there are lots of things that we can come out of that. Then you have the great guys between GK and, as Claire mentioned, DTL. So Grace Kennedy, benefited heavily through the food segment. Their 9 months basically surpassed their 12 months 2019 with just 1 quarter to go. And money sources was still taking a heavy incline in terms of growth. Even though the banking investment side took a hit or a slowdown. Let's remember that Grace Kennedy acquired a controlling stake in Key. So as Key gets into profitability now, it's going to start accruing basically to the insurance segment. And when you look at it even further with the food segment, people are still staying home. We still haven't have these events as yet, and we're still going to have school until probably like September 2021, if it's still safe to go about then. So Grace Kennedy is a great choice to look at, and even DERRIMON in that case where, as Claire mentioned, the ethnic market they're looking at. So when you talk about ethnic market, it says mainly particular diaspora or focused.
Right. So African and Caribbean, probably even some of that Latin American, Afro-Caribbean market as well. The Puerto Ricans, the Dominicans, they tend to have similar flavor palettes as we do. So we have a couple other things to look at, but first a couple other things to look at locally. But first I want to bring in Julian here, who's been eyeing the international markets. And Julian, you've been looking at Delta Airlines. What's up with Delta?
Well, Delta Airlines is actually one of the top 3 US airlines. So like the rest of the travel industry, the company faced significant headwinds from the COVID-19 outbreak. So what we realize is that revenues fell 64% year over year, closing at 17 billion. And this is as at their year end, by the way, which ended in December. So their net profit is actually coming through at a loss of 12.39 billion. So that's a difference of 17.15 billion compared to the prior year. The thing is that their expenses fell 27%. But that was mainly because they were using less fuel. That's because they were flying less. And as a result, from all of these stress factors, their balance sheet took a big hit. So their equity actually fell 91% year over year. And that's largely because the debt they had to borrow because they weren't getting all of those streams of income from actually carrying out their core operating activity. They had to borrow a lot more. So their debt actually increased by 3 times. They more than tripled their debt. So that took a big hit to their balance sheet. And we're really bringing this into the fore because some investors might feel tempted to take a bet on Delta when the economy reopens further in the US and in other areas and people start to travel some more, and people might say, okay, I want to take a gamble on a travel stock. But the fact of the matter is, from a risk to reward standpoint, it's extremely risky because of all of these factors. And investors need to at least know what they're actually going into, because this company has faced immense stress. Their cash flow negative, the balance sheet is weak. They have a good competitive position, but airlines are very, very, very competitive as an industry. So even though they're in top 3 in the US, it's still a very tight space for them to operate in. And that will impact profit margins.
Are all the airlines pretty much in the same boat right now, Julian?
Yes, similar, definitely in a similar position.
So you call all of them, categorize all of them as high risk right now?
Yes, for sure. I can say that in summary. Summary.
Let's look locally again. So Wigton Windfarm is a company that a lot of people are invested in. Clive, you've been looking at Wigton's latest numbers. What's up with Wigton?
I think the Jamaican economy is doing. One, people are staying home, and the data has indicated that electricity usage, energy usage has gone up. So JPS as well as Wigton, who is a feeder company, has done quite well. Interestingly, also on their last financials, up to September, October, they stated that the weather was favorable to them. And it's interesting that wind speed of 1.something% miles per hour more contributed to a significant rise in revenue for them. That's really very interesting on the technical side. So their revenue, so they did quite well, you know. Of course, I'm not sure if they have declared and paid a dividend as yet, but I think that company has a far way to, well, in terms of its potential is significant. What Wigton now has to, they have more or less reached their capacity, they said. Based on the equipment they have, they now have to think of replacing, which is heavy capital. It's a very heavily capitalized industry, replacing equipment. And they're also thinking of growing, that is building out more plants, that is more of these structures that can generate greater revenue, because they really are at their capacity now. So in terms of obsolescence, replacement, there's a heavy cost coming. They may have to come to the market to raise cap. Well, it is possible that they're now a public listed company. They could come to the market to raise additional capital, which is cheap. The only other way they can grow revenue now is either through cost cutting, or I'm not sure they can squeeze out any more efficiency, because they really are at capacity. So they might have to look at some way of managing costs in order to drive revenue. So they must grow in order to grow revenue in the long term. And then we'll need heavy capital investment, structure investment. So they more than likely, I suspect, we might hear within the next year or two, that they will come to the market to raise additional capital.
Well, they did give an indication. They were on Taking Stock a couple months ago, and they did give an indication that that's something they were interested in doing, and raising additional capital on the market. Well, before we go, let's take a last look at Salada. That's a company, I don't think we've discussed Salada on this program yet, but they've now announced the possibility of a stock split. David, you're watching that one. What's going on?
So around this time last year, Salada indicated that they want to consider a stock split around March, but at the same time, that was when COVID came around, so they postponed it. So they indicated on Tuesday that they're going to consider a board meeting again, and so they will approve it. And once it's approved at the board meeting, we then go to the shareholders at the AGM. So Salada had their last stock split in 2008, which was a 10-to-1 stock split. And the stock, rallied from like 2017, 18, from like $2 to like $30 around the range it is right now. And just on the news of the stock split on Tuesday, saying the stock soaring by 27% on Wednesday's trading, and it's still going up. because Salada has a very small float, meaning there are very few sellers with very few units, which basically means that as those buyers come in, it's a lot of demand but low supply, and basically makes sense that the price is going to go up higher. And this is good for the short term, right now for the company in terms of shareholders getting more value and potentially getting more liquidity in their stock if it's approved later on. But Salada itself as a company is getting some quote-unquote tight binds, because we saw about the Jackra case back in November, where the Supreme Court had a request to, temporarily hold or cut back on the restriction to increase the cess of local coffee to 30%. So in the 2017 financial year, which was the last time Salada used just imported coffee straight, their raw materials cost were around $350 million. Now it's at $490 million, and that was with a 10% use of local coffee. So you can see a significant jump in expenses just by using 10% local coffee in their current mix. So the fact that took a 30% overall mix is going to very heavily depress the income statement much further, because they took a 4% decline in revenue, which was kind of expected as on low domestic sales because persons were at home and everything else. But they took a 22% drop to net profit to $110.5 million, which was really driven by those higher expenses. And I said that the fact that going to increase their sales now to 30% cess for local coffee in their blend is going to really drag down increase expenses and drag down the income statement further. So the stock is good. Shareholders get the benefit of saying, hey.
And people, the market generally responds to news of a stock split. We saw what happened with the Key Insurance,
Jamaica Teas,
with Pulse, Jam Teas, yeah.
So it's going to be pretty interesting right now when it's approved and everything, because when we saw Pulse at their stock split, it's up from 8 to 13, till around 12, split down to $2.70, went to 5. Jam Tea was similar. Jam Tea split around $5.70 or around 6. Went on to 2.
Caribbean flavors and fragrances, same thing.
That as well, from 11 to. So I just said, the news is going to continue. It's going to give value to investors or shareholders in the short term, but in the current long term, we have to see what SEPROD is going to do to navigate this environment, because the regulatory environment is becoming relatively more hostile, because it's a local company, which even though you're saying, they should be using quote unquote more local coffee, they're performing themselves as a local company. It's really bad for them, because they're going to be dragged further, not because their business is suffering by inefficiencies or so on, but just because the regulators are forcing them to actually use a particular input, which is deleterious for their cost base.
Mm-hmm. Well, thanks you so much, guys. You gave us a lot to chew on this week. We covered a lot of ground in this particular episode. We'll talk again soon.
Thanks, Kalila.
Okay, thank you very much, Kalila. And Happy New Year. Yes, Happy New Year to all, including the viewers.
This segment of Taking Stock, The Analysts, was brought to you by Jamaica Money Market Brokers and Proven Wealth. That's our show for this week. Thanks for watching. Make sure you like this video, subscribe to this channel, and share with a friend. Also subscribe to our newsletter at KalilaReynolds.com and turn on those post notifications so that you can be the first to see all my other videos. We want to help people learn more about money so we can all get this money together. Now this week on Money Mondays JA, we explain the concept of equity. What does it mean when you have equity in something? And on Money Moves JA, we're talking to customs. Did you know that you can access duty-free waivers for certain business inputs? You don't want to miss this episode. Follow me on Instagram and Twitter at Kalila Ray, and follow at Taking Stock JA on Instagram. If you want to connect with the analysts this week, check the description box below for their contact information. Also visit our website, KalilaReynolds.com, for financial information you can use however you like it. Watch, listen, or read. Now tell a friend about Taking Stock. Investing is the new sexy. So let's make it cool to talk about money. I'm Kalila Reynolds. Stay safe.